Is the market overvalued? Is the market overheated? And what should investors do? Simply speaking about money. What if I told you that some investors are buying stocks today at prices that assume everything goes perfectly for the next 10 years? No recessions, no surprises, no bad earnings, no human beings doing human being things. If that sounds a little optimistic, you're in the right place. Today, we're answering three important questions. Is the stock market overvalued? Is the market overheated? And most importantly, what should ordinary investors actually do about it? Welcome to Simply Speaking About Money, the channel where we focus on budgeting, saving, and investing based on probabilities, not possibilities. No hype, no crystal balls, and no investing strategies that rely on your neighbor's dog predicting the stock market. Whenever markets hit new highs, people start doing strange things. Some become convinced stocks can only go up. Others become convinced a crash is coming tomorrow morning at exactly 9:31 a.m. Greed tells them to buy after prices soar. Fear tells them to sell after prices fall. It's almost like our brains were designed specifically to buy high and sell low. Oddly enough, both groups are usually wrong. Many investors make decisions based on emotions instead of evidence. A market can be expensive. A market can be cheap. A market can be fairly valued. The challenge is understanding what those terms actually mean. Let's start with overvaluation. When investors say the market is overvalued, they're usually saying stock prices have risen faster than the earnings of the companies behind those stocks. Prices are running ahead of reality. Think about a house. If a house worth $300,000 suddenly sells for $900,000, you would probably ask a few questions. At the very least, you'd want to know whether the kitchen dispenses gold bars. Stocks work the same way. In part 1 of this series, we discussed P/E ratios. Remember, a P/E ratio measures how much investors are willing to pay for a company's earnings. Higher P/E ratios often mean higher expectations. The problem? Expectations can become unrealistic, and unrealistic expectations eventually run into reality. Reality usually wins. Now let's talk about overheating. An overheated market isn't necessarily the same thing as an overvalued market, but the two often travel together, like bad decisions and social media investing gurus. An overheated market is driven by excessive enthusiasm. Investors stop asking, "What is this worth?" and start asking, "How much higher can it go?" That's often a warning sign. When everyone believes prices can only rise, caution disappears, risk gets ignored, and common sense quietly leaves through the nearest exit. History has seen this before. The dot-com bubble, the housing bubble, various speculative manias throughout history. Human beings have a remarkable ability to convince themselves that this time is different. Strangely, it almost never is. Think of the market like a rubber band. A healthy rubber band stretches. That's normal. But if it stretches too far, tension builds. Eventually, it snaps back. Not because it hates investors, because that's what stretched rubber bands do. Markets behave similarly. Prices can move above fair value, sometimes for months, sometimes for years. But eventually, fundamentals matter again. So, how can investors tell if things are getting expensive? Look at valuation metrics, P/E ratios, price-to-sales ratios, historical averages, not headlines, not social media comments, not your cousin's can't-lose stock tip. Valuation metrics aren't perfect, but they're far more reliable than emotional predictions. And significantly cheaper than hiring a psychic. Another sign of overheating is extreme optimism. Pay attention when investors start believing risk no longer exists. Risk never disappears. It just gets ignored, usually right before reminding everyone that it exists. If you're finding this helpful, take a second to like the video and subscribe to the channel. It helps us reach more people who want practical investing education without the hype. Now let's keep going. Here's what long-term investors should not do. Do not panic. Do not sell everything. And definitely do not build an investment strategy around a headline. Headlines have a lifespan, roughly equal to a carton of milk. Many investors see expensive valuations and immediately predict a crash. But expensive markets can remain expensive for surprisingly long periods, sometimes years. Trying to perfectly time the market is incredibly difficult. Professional investors struggle with it. Economists struggle with it. Television experts struggle with it. The rest of us should probably remain humble. Instead of predicting market tops, focus on managing risk. That's a much more productive use of your energy and significantly less stressful. Diversification matters. Owning different companies, sectors, and asset classes helps reduce risk. It's not exciting. Neither is wearing a seatbelt. Both are good ideas. Regular investing also helps. By investing consistently, you buy at high prices, low prices, and everything in between. You stop relying on perfect timing. This approach is called dollar-cost averaging. It isn't glamorous. Nobody makes a movie about it, but it has helped countless investors build wealth over time. Keep your emergency fund intact, avoid excessive debt, and maintain a long-term perspective. Those habits matter far more than predicting next month's market movement. Remember, investing success rarely comes from making one brilliant decision. It usually comes from making dozens of reasonable decisions consistently. That's not exciting advice, but boring strategies tend to have an annoying habit of working. Many investors spend years searching for the perfect stock. Meanwhile, consistent investors quietly build wealth, one contribution at a time. If markets are expensive, you don't necessarily stop investing. You simply recognize that future returns may be lower than average. That's a very different conclusion. Expensive markets call for realistic expectations, not panic, not euphoria, just realism. A surprisingly underrated investment skill. Investing based on probabilities means accepting uncertainty. Nobody knows exactly what happens next, and anyone claiming otherwise is selling something. The goal isn't to predict tomorrow. The goal is to prepare for many possible tomorrows. That's what successful investing looks like. Here's the simple takeaway. A market can be overvalued. A market can be overheated. But neither automatically means you should abandon your long-term plan. Focus on diversification. Focus on consistency. Focus on valuation awareness. And focus on controlling what you can actually control. The investors who succeed over decades aren't usually the smartest. They're often the most disciplined. Discipline beats prediction far more often than people realize. Markets rise, markets fall, valuations change, emotions come and go, but a disciplined long-term investing strategy can survive all of it. If you enjoyed this video, please hit like, subscribe, and turn on notifications. You'll also find helpful resources and recommended investing tools in the description below. If they're useful to you, they help support the channel at no additional cost. Thanks for watching Simply Speaking About Money. Remember, budget, save, invest, and invest based on probabilities, not possibilities. We'll see you in the next video. Budgeting is step 1. Investing is step 2. That's where Acorns comes in. Acorns helps you start investing automatically, even with your spare change. It rounds up your everyday purchases and invests the difference into diversified portfolios built for long-term growth. You don't need thousands of dollars. You don't need to be an expert. You just need to start. When you pair smart budgeting with automatic investing, you build momentum, and momentum builds wealth. If you're ready to make your money work while you sleep, check out the link in the description to get started with Acorns affiliate disclosure. I may earn a commission if you sign up using my link at no extra cost to you.